Welcome back, everybody. Today, we just wanted to give an update on what's going on in the world and kind of what we're seeing out in the market. So, Quint, I'm going to pass it off to you. And I mean, what is going on?
Yeah, it's fascinating, Logan. Traditionally this time of year is really, I don't know, for lack of a better word, I'll say laid back. It really tends to be slow in the market, especially after a year has been as robust in the markets as we've seen. People typically, they take some time off in Wall Street and it's just kind of status quo. Let's not mess up the apple cart. There's an old adage that, when those Wall Streeters are banking on that bonus, they're not going to do too much. Because again, it takes transactions in the marketplace to create volatility. So people have to consciously buy and sell securities in order to move markets and prices. But that seems to be out the window this year. And there's a variety of reasons for that. I would say the predominant kind of out of left field issue that we're facing is the Omicron variant, which obviously everybody's heard of by now. I'm not, proficient in what's happening with the virus, how it will mutate, et cetera. But from a Wall Street perspective or from an investment perspective, I think investors are more concerned about the reaction to what politics or governments will say in regards to travel or, restrictions, stay at home, et cetera. Now, I think everybody that will be around will tell you we're not going back, right? We're not going back. I thought it was interesting where on one hand, we're talking about the cases that are popping up in different countries and they're shutting down. And then the other image is, Michigan beating Ohio State and there's 100,000 people on the field. It's kind of an oxymoron. But again, I think that was the news out of left field that sort of sparked the initial market sell-off. However, the interesting thing is that if you were to have asked me when that transpired, what I thought would happen with the market, I would have actually said, you know what, Logan, this is probably bullish for the market. And you would have been, maybe not you, but most people would be like, what? What are you talking about? We have a new virus or a new variant that's threatening the economy. How could this possibly be bullish? And I would tell you that what the market is most concerned about in the big picture is the Federal Reserve and their action surrounding tapering, which we'll talk about in a second, and also interest rates. The market is very concerned about that because we've been living off of this liquidity pool for such a very long time that when that is taken away from us, there's going to be a reset. It's natural. It's normal. If you give your kid candy, after a day, 2, 3, 4 days, they're going to become accustomed to all the sugar. Try to take that candy away, they're going to lose their minds, right? They're going to come off of that sugar high and they're going to kind of go crazy. We've actually seen this before. Janet Yellen in 2018 talked about tapering the balance sheet from the Federal Reserve, and the market was just thrust into turmoil. We actually saw a 20% decline in the fourth quarter of 2018. I think it actually all came in December. So going back, that's the big concern of any market participant. Now, again, it's important to understand why. Let's dissect that a little bit. Those at home kind of watching this. It's not so much, it's easy for somebody and very flippant to say, well, we just easy money always goes into the stock market, et cetera. Well, yes, that's true. But that's kind of like saying the Fed's just printing money. And the reality is, until just recently, that actually wasn't the case. Okay, we don't need to go down that path today. But the reality is that the market is a discounting mechanism based on variables that we look at in various businesses. So, for example, if you run a business and you're projecting out your future income versus expenses, one of the things that you might have to project out is the interest expense you're going to pay on the debt you have as a business. Now, some people right home say, well, they shouldn't have debt. Well, okay, but let's say that you're, Boeing, a bad example, an industrial company, and you borrow money to buy massive equipment that you hold and then eventually sell. That's your business model. And some people operate on that. Many companies do. In fact, they operate on a tremendous amount of debt. So to service that debt, you have an interest rate. And the interest rate becomes your interest expense. So income minus liabilities equals profit, right? If you're a publicly traded company, I'm going to evaluate you and your merit as a business based on your income minus expenses and your profit. If your interest rates go up, your expenses go up and your profit goes
down.
It's basic math, right? Income, and hopefully the income stays the same.
Right.
But if a company buying from you just saw their expenses go up as well, they might not buy as much. So the interesting thing is you might have a double whammy where your income goes down because people's expenses have gone up and your expenses have gone up. Needless to say, your profit's going to shrink. And me as an investor, I'm going to say, you know what? I'm not willing to own this stock at this price if their profits are shrinking. Okay, so that's the math behind it. So if we see higher rates, if we see higher interest rates, the market needs to adjust its expectations based on that. Okay, so that's an understanding of why the market cares so much about interest rates and the Fed and so on and so forth.
And you just mentioned interest rates, and I think interest rates are a lot of the time what people think about. But why then is tapering such a big effect?
Yeah, so there's actually two things, and I'll touch on that, and then I'm going to circle back to what I said in the beginning of how I would have initially thought that the virus would have been a bullish thing. Okay, so you have interest rate mechanisms that the Fed controls, right? The short end of the interest rate curve, and we don't need to go into the mechanics of that, but that's just an understanding. The other thing they've been doing for years is been actually buying bonds. Now, they've been doing that to provide liquidity to companies to also keep interest rates low. So it's another methodology by which to keep interest rates low and provide liquidity. But the reality is, whether they raise interest rates or stop buying bonds, the effect is higher interest rates. And the concern is less income, higher expenses, lower profits, sell stocks. Okay, that's the Fed's mechanics to the whole market and why participants would be concerned. They do this, they would sort of raise interest rates or taper their balance sheet when the economy is so robust and they're concerned about inflation, something we've talked about ad nauseum, to slow the growth and slow the inflation down. So that makes sense. Oh, it's so much inflation, people, let's slow it down, let's taper, etc. Okay, except we have this new introduction of a variant that comes into play that's probably going to slow the economy down on its own. Or at minimum, we have to kind of wait and see. So when it came out, the idea is, and many people, including myself, this is actually not bad because this is going to slow the economy down on its own. Supply chain might have some time to catch up, right? Commodity prices have coming in and all that has happened. That is actually happening right now. Oil is off considerably. We're not seeing it at the pumps yet, but we should. Commodity prices, copper, lumber, steel, etc., are declining because of this new variant and because of the concerns surrounding the economy. However, a few days after this variant comes out, Jerome Powell, obviously Fed chair, comes out and says, not only are we considering tapering, selling off the balance sheet or stop buying bonds, we might speed it up. So on one hand, we have something that's potentially hurting the economy and a Fed who either, for whatever reason, has been out to lunch over the last 72 hours or just wanted to see what would happen. And that's an interesting exercise. But they added further negativity to that, which ultimately, now we have slowing economy, sell stocks, Fed potentially raising interest rates, sell stocks, and we have a significant sell-off that's transpiring, very similar to 2018. Now, that's what's happening, okay? That's what's transpiring. So what do we do about it, right? What do we do about it? This is precisely why we did the video on standard deviation and risk. And I really encourage you. It is 52 minutes of your life. Right? 52 minutes. And probably 26 of it is actual material. 26 of it is just me having fun. So 26 minutes being entertained, 26 minutes of genuine education. But I would encourage you all to go back and look at that video and understand that whether it's the variant whether it's the Fed, I don't care what it is. These are going to transpire. And it is, number one, why we have appropriate allocations. What is an allocation? How much stock versus how much bonds. It is also why we understand that when this transpires, we don't freak out. We don't make irrational decisions. Oh, my goodness, we're going back. I remember this from March of 2020. Let's hit the eject. No, we don't do any of that. None of that. We look at it objectively. We know that it's sometimes when taking candy away from a kid, he's going to freak out. And more often than not, the wise move is to look at this and say, is there opportunity here? Now, in my opinion, okay, it's too early for the opportunity game. What's more important is to look at this and go, this could be a bumpy road because you got the variant, which is totally unknown. We could go back to where we were in 2020. Oh, my goodness. We're shutting everything down. I don't think that'll happen. But again, I don't know. But we have a Fed that seems to be going, well, regardless of this variant, we're going to keep doing this, which seems a little backwards. That's not been their MO. So that tune can change. Meanwhile, the markets are very uncertain. And think about it. I'm very outspoken with opinions. Mm-hmm. And if I don't really have a strong opinion one way or the other right now, I can tell you nobody does. Very few. And if they do, they're guessing. They're totally guessing. So it's a time to take a step back, be patient. I don't think there's irrational things to be doing, knee-jerk reactions, sell this, buy that. No, I don't think that. The picture will become clear in the near future. But ultimately, for those of people that aren't clients, for example, because I know a lot of people who watch this that aren't clients, I think, make sure you watch Standard Deviation, the video about risk, and make sure you understand your risk tolerance, because we've seen a lot of people who are overly aggressive. They're too aggressive. They've become accustomed to this idea that markets go up every day, and that's not the case. And they're going to have a rude awakening when they open their statement at the end of the quarter. So if you're predicting your retirement based on these returns that you've seen over the last several years in the market because you've been overly aggressive, maybe time to get with an advisor and really hone in on that going forward.
Absolutely.
I didn't let you speak at all.
That's okay.
None today.
No, well, you did your thing, and hopefully you all found value in it. So watch this video and then go back and feel free to watch the other videos that we've made recently.
They already did watch this video.
That's a good point. That is a good point.
No, let me conclude by this. You did a great conclusion, but I want to conclude this one. Here's the deal. Over the next few weeks, and this is one of these things, we're going to have to keep coming on talking about this, because there's going to be a lot of information. We don't know what's going to happen with the variant. So if you're trying to make an investment decision based on that, you're guessing. We don't know what's going to happen with the Fed. If you're trying to make an investment decision on that, you're absolutely guessing. It is a wait and see market. And unfortunately, many times that's the case. So that's why we favor indices, index funds over individual stocks in a majority of our portfolio. Why? Because those indices can be replaced by other companies over time, and over time they will move higher. They will rebound. We like indices that provide dividends, etc. We like being diversified, making sure that we're owning emerging markets, some gold, international, different capitalized stocks, small, medium, large, etc. So all of the basic tenet principles of investing, I think, comes into play here. It's very important to get back to the basics. Make it a great day.